Hi, Dominique. Welcome to another edition of The Week Ahead. How are you doing?
Very well, thank you. How are you, Andrew? It's good to chat again.
Yes, of course. I'm good, thank you. So let's dive right in. So we still don't have a resolution, but the markets have been rallying, and I was looking at, I think, a trade we were talking about fading all of these cuts that were being priced in. Some massive moves there now. Yeah, so first, kind of, what were your key takeaways, I guess, from the political situation, but also from markets and obviously the data over the past week?
So from the political situation, as I expected, the House Freedom Caucus dug its heels in. They publicly committed to not accepting any compromise, and they did so again yesterday. And what that means is that any deal is going to have to be ratified by both centrist Republicans and Democrats. And what that means also is that we may have a deal, a so-called deal between the negotiators, between the White House and Speaker McCarthy and his representatives. But it's going to be a stretch to get it voted. And that's where I think the market is really too optimistic.
Yeah. Yeah, I think right now it's, and you've been consistent on that, by the way. And I think first, your thought has been kind of driving the view 2 weeks ago when people thought there was going to be an immediate resolution, and you were pretty sure for some of those reasons. And now, even if they do come to some kind of deal, and McCarthy tries jamming it through, it may be very messy. I did see that a group of centrist Democratic congressmen said they would potentially support McCarthy. I guess that's also if maybe the one Republican tried voting him out as well, which is also, I guess, another wrinkle in this whole thing.
Yeah, but to be honest, I don't think McCarthy wants to be kept in power by the Democrats. That would be a bit of a poisoned chalice.
Yeah, that's why they didn't do that before, right?
Exactly. So it's a mess, and I think it's more of a mess than the market is currently thinking.
Right.
I mean, what's going on here is that both sides are trying to get public opinion on their side. So they are claiming progress, best effort, working through the night, blah, 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 blah. But the bottom line is that the demands made by the Republicans are really extreme, and they are going to have to move to the center, and that could take time.
Yeah. Yeah. Well, so far over the past week, I guess we've seen equities pretty strong. Well, I guess it dipped a little bit early in the week, and now obviously like big rally coming into. Now this is also somewhat driven by all the focus on AI hype, including in our company, which is awesome. But I guess also, behind the scenes, or like fixed income's been selling off pretty hard. And I guess driven by, and you were 100%, you were 1 in 100, I would say, in calling 2 weeks ago for a hike in June. And now, whether it's June or July, either of those look pretty likely. One of those looks pretty likely. Have you been surprised by how the markets have reacted? Certainly, while all this is still going on in the background.
So now I'm kind of getting used to, and actually I don't enjoy it at all. I wish I was closer to the consensus, but I had to follow the data. And so I'm kind of getting used to being out there and then the market moving my way. I mean, it's basically, I thought the data would really push in the direction of a hike. And if you listened to FOMC members, even Dove, like vice chair or vice chair nominee Jefferson, noted that inflation, core inflation, especially hyper core inflation, is not slowing. And so those guys can't ignore the data. I mean, the market can ignore the data for a little while, but the Fed cannot. So yeah, I mean, it's nice to see things moving my way, except that a lack of resolution of the debt ceiling would, of course, prevent the Fed from hiking in June. So I guess I'm hedged. Either way, I'm wrong on the debt ceiling, and I will be right on the Fed, or vice versa. But we'll see.
Right. But to touch on like medium long term, do you still see, say, over, I mean, obviously you're looking at stuff day to day, like the Fed, but over the next 1 to 2 years, do you still see inflation difficult to bring down? I mean, we're assuming the Fed doesn't get to your 8%, and but you know, the underlying drivers, is this something that could dissipate in the next 4 months, or do you think it will be hard to beat over the next 1 to 2 years?
Unfortunately, we are in a situation where inflation expectations are high, to use the BIS terminology. So when that happens, everybody is expecting that everybody else will push up their prices, their wages. So you get a feedback loop between wages and prices. And because wages are determined independently of prices and prices are determined independently of wages, there is no way to bring them down together other than with something like a recession or a very scary Fed. And the Fed has very little credibility. So they will have no choice but to show that they mean business and really break the expansion to bring down inflation expectations. I mean, the one risk to my forecast would be if there was a big decline in energy prices, because this would bring down inflation expectation on the part of both workers and businesses. This would also increase income, real income. So people will be quite happy to demand lower wages and lower prices. But frankly, you know, I see what Viresh is writing. I see what the Department of Energy is saying, or the International Energy Agency, and that, you know, we're all singing on the same hymn sheet here.
Review prices should be fairly well supported under 70
in the second half.
And in fact, we'd have to get Viresh on and talk about it, but I see like gasoline prices actually are up this year, even though you know, WTI or Brent is down. So what was the other question I was going to say? So okay, so that's interesting. What about this other risk that they do come to some agreement, but one of those, you know, one fallout is less government spending over the next kind of 1 year, or even if they made cuts, is it always going to be one of those things like, oh, it's going to be implemented over 10 years, and so the cut never really happens, or is there a risk that we can get, because we all agree that with inflation here, how strong the economy is, we should not be running deficits of 6%.
Actually 7%. So yeah, I would say fiscal policy is out of control. It's not just the deficit is 7%, but the unemployment rate is the lowest in 50 years. So on a cyclically adjusted basis, we probably have one of the loosest fiscal stance since World War II. I say we can tighten a bit without killing growth. I mean, obviously, if we go to a balanced budget from 7%, then we will have. Yeah. But there is no incentive for the administration to settle for a deal like this one. And I don't think that's what the Republicans are demanding either. So let's see what the deal will look like. But certainly a bit of fiscal consolidation would make things easier for the Federal Reserves.
Okay, that makes sense. So you kind of don't see something happening this weekend. I guess that it doesn't look like it's happening today. And obviously, even if it does happen, there then needs to be a vote over the coming days between Congress and the Senate. Okay.
So the vote
do you
would
see
be on
anything?
Tuesday.
Yeah, are there risks for this weekend?
No, I hope we can all enjoy ourselves, but I think, you know, we are going to hear more about, we are working around the clock, we will avoid a default.
We're not enjoying Memorial Day. It's also a bank holiday here in the UK, and my birthday on Sunday.
Oh, happy birthday. I hope you get a nice big cake. Yeah, so in terms of what's coming up this week, we have a few Fed speakers, Barkin, Collins, Harker, Jefferson, Bauman. I think the more interesting one will be Jefferson, because he's a vice chair nominee. He's going to talk about financial stability and the US economy, and possibly comment that so far it's hard to see much impact on growth from the so-called credit crunch. We'll see. So that's the one to look out for. We will get the beige book, which, you know, as you know, I don't think is a great source of insight. I mean, this beige book gets published because once upon a time, a congressman got a bit worked up about the lack of Fed transparency. And so that beige book is so nuanced that it's really hard to get any facts, any information out of it. We do have a scoring for the beige book, which our clients will be able to refer to.
Yeah.
But in terms of anecdotal evidence, it's going to be once more the double-handed economist, and between the left hand and the right hand, it's really hard to know where is the overall direction. So basically, the speakers are the main event. In terms of data, we have, of course, the NFP, and there the forecast, the consensus forecast, which is a tad under 200,000, seems reasonable to me. To me, the most important part of this print will be wage growth. Last month, wage growth jumped to 50 basis points month on month from previously a string of 30 basis points. And I don't think this is only noise. I think, you know, we've seen real wages accelerating for a solid 3 quarters.
Right.
And it was only a matter of time before nominal wages also started to pick up, given how tight the labor market.
Okay, so you're definitely at a consensus, because if I look on Bloomberg, the survey is 0.3%.
Yeah, so I think we get more than that.
I guess it was low last month, and it came out quite high. So if we get another 0.5% print, that would, you know.
Well, I mean, if we get 200,000, yeah, but still 200,000, I think it's enough for a June hike without a debt, assuming the debt ceiling is resolved.
Gets resolved.
Yeah, because the Fed is really worried about hypercore, so core services excluding housing. They know that it's driven by wages, and they know that wages are driven by labor market tightness. And with the unemployment rate where it is, I mean, you know, this is just plain old economics, demand and supply. So 200K is probably, even if I'm wrong and the consensus is right and wage growth is only 30 basis points, I think 200K is enough for a June hike, assuming no ceiling prices.
And on a June hike, then it's probably they're on pause at least till September, or at least till Jackson Hole, like that.
Yeah, Jackson Hole will be very interesting.
Yeah.
Well, it's always interesting, but it's clear that the 500 basis points that they have done is not biting. Another data point we get next week is home prices, and the consensus expects an increase month on month. So we're talking about residential real estate, which is the most interest rate sensitive component of demand. And prices are stabilizing. And even if you look at the GDP, there was a big decrease in the contraction in residential investment in the first quarter. And it could very well be that this quarter, residential investment turns positive quarter on quarter. So policy is not restrictive enough. So it will be really interesting to see if Jackson Hole is basically the Fed throwing the towel and admitting that it's not done enough to slow the economy and bring down inflation. But anyway, so back to what's going on next week. We also have a series of PMIs, the ISM manufacturing, the Chicago, I can't say this word with a proper, okay, I won't comment, but this is one word I have difficulties with, Chicago. MNI's manufacturing survey, the Dallas Fed.
The Windy City.
The Dallas Fed manufacturing survey, I agree with the consensus. Those surveys are moving sideways. In any event, manufacturing is not that important for the economy. Then we get one of the prints that is my favorite in terms of criticizing it, which is jobs. And I've been saying forever that job openings have a very weak relationship with actual hires. And otherwise, I think that the headline number on opening tells us very little because it has only a weak relationship with the number of actual hires. In other words, firms are advertising job, or there is a problem in which the data on job opening is collected. But anyway, the number of hires is much, much smaller than the number of openings advertised. So in that release, what is interesting really is the layoff rate and the quit rate. And those have been weakening from unsustainable levels, but they remain stronger than before the pandemic. And that's basically what I'm expecting next week.
Okay. It's not a great connection, I'm not sure, but okay, let's maybe end there, and I'll just do a quick recap for some of the pieces this past week, particularly for our kind of pro and now new wealth platform, which we definitely, any wealth managers, family offices, we highly recommend to reach out to this. I guess we'll call it kind of in the beta stage right now, and because we'd love to get great feedback. We've already gotten some awesome feedback, but this really will be about creating community. Eventually we'll have in-person dinners, events, deal sharing, but there'll be a lot of kind of super interesting stuff for people. So some of the Bilal released his macroscope, our foreign investors actually buying US assets, which is super interesting, obviously, with everything going on. Also, a lot of the inflow of capital.
Yeah, I was amazed.
Yeah.
I was amazed to see the inflow of foreign money into treasuries. So whoever is calling for the demise of the dollar as a global currency needs to look a little closer at the data, it seems to me.
Exactly. We do real research, not just for slinging around things on Twitter. Yeah, so that's a super interesting piece, and definitely, especially for people who have seen all this stuff about people calling for the end of the dollar, and this is actually the real facts. The global rates weekly from Henry and Mustafa actually did a very interesting exercise, actually trading a debt ceiling resolution. So now we may actually be getting closer. Let's see, as you mentioned, even if we get something, does it get through Congress? With all the focus on growth in China, for people who don't know, we have our independent way through hard and soft data of assessing Chinese growth, and that's actually predicting a soft composite PMI coming up. So generally weaker growth in China from the data that we see. I rarely talk about podcasts, but I haven't listened to it yet. I'm very excited to listen to it this weekend. But Bilal did a podcast with Jim Rogers, who's obviously a real legend, especially in the commodity space, but also actually with a focus on Asia as well. So that should be super cool and very interesting. And then I guess last thing is we're increasing our kind of focus on FX volatility and the output we're doing there. So please check out the work that Dalvir is doing. We're trying to put some more trade ideas around it, but any feedback there would be greatly appreciated. And everyone, US, UK, obviously around the world, but if you have a holiday, enjoy the long weekend. If not, have a lovely weekend anyway. And I don't know, any parting words, Dominique?
As always, please keep the feedback going. Negative feedback, especially helpful. And good luck, everybody. And I hope everyone has a really restful weekend.
Thanks. Okay, goodbye.